All right, guys, let's start with tonight's session. So, as we said, tonight we'll be starting off with the revenue, and the idea is to also complete it or go through it to the end. So, revenue, I think in terms of importance from the recent ITC, you can see that this is a topic that has become important, or probably for this year, it was an important topic. In order to really score good marks for accounting, you needed to have strong understanding of the principle. So as we talk through the principles of the standard, we're also gonna be talking about how to navigate the actual standard. Because as it stands, it's actually the longest standard in terms of the ITC syllabus. It's got, as part of what you need to know, the main standard, then it's got the application guidance, the B section, and it's got a very big section on the illustrative examples. Understanding or having the opportunity to go through all those sections can make a tremendous impact or a positive impact on your preparation and also on the attempt of questions dealing with this particular standard. And in terms of the scope, and this is also quite important as we are going to be talking about IFRS 16 tomorrow, that you need to understand that sometimes you might be dealing with a company and the company might be assessing a contract to check whether that contract should be in IFRS 16 or it should be in IFRS 15. So you need to understand that there is a link or there's a very thin line between whether you are in IFRS 16 or you are in IFRS 15. And after tomorrow's session, you'll be able to better understand what makes IFRS 16 different from IFRS 15. But what we can see from the scope standard, what they are saying is that the key thing or the kind of contracts that we're going to be looking for here are contracts that the entity enters with customers. And then the entity then, or the standard then, goes on to define where the customer is. And it says that that's the party which you contract to in order to deliver goods that you deal with as part of your ordinary activities. So that is essentially what a customer is all about. It means that they need to be a contract and you need to be delivering to that particular person goods that you will normally deal with, or you'll normally sell, or service that you normally provide. So they're trying to clarify that if today I decide to sell my building and I'm not entering, or I do not normally buy and sell buildings, that means such a transaction should not be accounted for in terms of IFRS 15, but it should rather be an IFRS 16 where I'm just simply disposing of a PPE asset. So essentially what we'll be dealing with here will be the disposal or the sales of inventories. And it makes it clear that if a contract falls within the scope of IFRS 16, then it cannot also fall within the scope of IFRS 15. So it's either is an IFRS 16 contract, in which case it's a lease, or if it's not a lease, it can be an IFRS 15 contract. And the tricky thing right now for such a question, it means that you might be sitting in an exam where they say that discuss how this contract will be accounted for in the books of the company. And your biggest challenge or the greatest risk with such a question is whether you're going to conclude whether it's in IFRS 16 and therefore continue to discuss the requirements of leasing, or whether it's actually in IFRS 15 and therefore continue to discuss the requirements of IFRS 15. So that is what you can imagine to be the tricky thing that's going to come out of this. But they also clarify that one contract can actually have different components. It can have in itself a leasing contract as well as a maintenance contract, for instance, in which case the leasing contract will be in IFRS 16 and the maintenance contract will be in IFRS 15. So you also need to be careful of that, because as you will see even tomorrow, it is quite possible to have a contract that will be dealt with by different standards, and you might need to identify the different consideration in that particular contract. And furthermore, they clarify that contracts relating to financial instruments are also excluded from the scope of IFRS 15. Then, what is IFRS 15 all about? So the next slide, or the slide that you've got here, actually highlights that IFRS 15 is actually summarized in these 5 key steps, where they say that step 1 is relating to the identification of a contract. So you need to identify whether the contract you are dealing with is actually an IFRS 15 contract. Then number 2, you need to identify in that contract the performance obligations. And then step number 3 is to actually say, all right, in order to fulfill this performance obligation, what am I going to be paid? What is the transaction price in the contract? And then step 4 says that only if you determine that in step 2, you've got more than one performance obligation. So you only talk about step 4 if there is more than one performance obligation. If you only have a single performance obligation, step 4 disappears. So step 4 says that the transaction price you've identified, it needs to be allocated to the different performance obligations identified in step 2. Then step 5 talks about what? It talks about that you need to satisfy the performance obligations before you recognize revenue. So that is the framework of this particular standard. And if you look at the standard itself, the main standard, that's what it focuses on. But there are some things that are related to this key framework that I actually dealt with in the B section or the appendix section, and therefore you need to be clear and understand that some of the things that we're going to talk about later might not be dealt specifically within this particular step, but the principles from these particular steps are actually applied in terms of thinking about them. For instance, the B section talks about a material right. It talks about warranty provisions. It talks about agency and principal relationships. So those things are not mentioned even once in the main standard. And therefore, it becomes quite important for you to actually read the main standard as well as the appendix section in order to be able to master and understand the core principles. So let us just go through it step by step then. Let's start with step number 1, identifying the contract. So what we are saying is that you are sitting there and you have identified that you've got a contract with a customer. And before you go any further, before you start applying this particular framework, you need to identify whether that contract should be accounted for according to the principles of IFRS 15. And they say that for you to be able to do that, you need to assess whether the contract meets the following 5 requirements. So all of these requirements that are outlined in paragraph 9, they have to be met. Number 1, that contract that you've identified, it has to be approved by the parties. And in an exam, to check for approval is probably to say whether the contract has been signed by the parties. That's how you determine whether the contract has been approved and the parties are committed to their respective obligation. That's number 1. Then number 2 is to assess what are the rights of the parties in the contract. Remember that generally a contract will have 2 parties. It will have the supplier or the entity, and it will have the customer. So what are the rights that each of these parties is entitled to? So for instance, I as the supplier, I'm entitled to payment after I have fulfilled the performance obligation. So generally the supplier will be entitled to the consideration or to the payment after it has fulfilled the performance obligation. Whereas the customer in turn will be entitled to the goods or service after it has committed to pay the consideration due under the contract. So when you talk about rights in this particular case, you need to address the rights to the customer and the rights to the supplier. Then the next thing that you need to consider is whether the contract has commercial substance. And simply in this particular case is to consider that if we are in the business of doing something, surely there must be value in it. So in other words, any company that sells cars, we will assume that they make a profit from the sales of cars, because we're not going to assume that a company will have ordinary activities that do not generate value for it. So the fact that a company is involved in this on a day-to-day activities can be evidence enough that there is what? That there is value in what it does. In other words, it buys something for 100 Rand and it sells it for 120. That is the value that we are talking about. But if we are talking about a company that consistently buys something for 100 and sells it for 80 or less than 100, then we are saying that that transaction has no commercial substance, and therefore it does not make sense for it to continue to be their ordinary activities. Then the next thing is to do what? Is to identify the terms or the payment terms under the contract. So here it's to assess how is payment intended to be made by the customer. Is this a cash transaction where you go to the likes of Pick n Pay, ShopRite, and you say that you want this particular goods, here's the cash, and you walk away, the transaction is concluded? Or is it a situation where you say that I have to pay for the goods in advance and the goods will be delivered at a later point? Or is it a situation where I'm buying maybe clothes on credit and I have to pay over a 6-month period? So here we are just talking about how the payment has been arranged or how the customer is going to make payment to the supplier. So that's what we are addressing in terms of the payment terms. So they have to be identified. So in this particular case, they will outline to you what is the arrangement between what? The supplier and the customer. Is the supplier required to pay in advance, later, or over time, and so on and so on. Then the last thing is to consider the probability of receipt. So now that we have agreed that you will pay so much under this particular contract, is it likely that the supplier will get all its money from the customer? And the standard says two things have to be considered. Number one, it is whether the customer has got what? The ability to pay. So we have to look at the customer's ability. And this is more of an objective exercise. So this is where we probably do an ITC check and see whether the customer is probably blacklisted. If the customer is blacklisted, we can actually argue that probably the customer is unable to do what? To make payment or has the ability to make payments under the contract. Or probably they can tell us that the customer is actually making losses. If someone is making losses and they want to buy from you on credit, you have to be a bit cautious to say that, am I going to receive the money from this particular customer? Or probably they can tell you that the customer has a credit rating of AAA, or the customer has a credit rating of junk status. So those are the kind of things that you can actually consider when you assess the ability of the customer. At the back of the standard, there's actually an example that even takes it further, and they describe the scenario that the customer or the environment that the customer is in, and they say the customer operates in a highly competitive environment. And when they assessed the customer's ability, they say that operating in a competitive environment can actually be considered to be a negative factor when we look at the customer's ability to pay. So that's something that you need to be careful of, to say that we probably don't need to limit our discussion to how the financial standing of the customer looks, but we might need to consider other economic factors that might affect the ability of the customers to pay. Like even right now, when they are granting credit, they can say that the South African economy is not doing so well. So as a result, yes, you might be working, but there is a risk that the economy might continue to depress and you might lose your job. So in assessing the customer's ability to pay, they are not only looking at the customer's current financial status, but economic factors can actually be taken into consideration. Then the other thing that needs to be taken into account, it's actually what? The intention of the customer to pay. So someone can have the ability to pay. In other words, they've got the money, but they might not have the intention to pay. That's what the standard is arguing. But then they realize that in practice, it might be a bit difficult to assess whether someone who's got the ability does not have the intention. And they say that simply for practical purposes, you can assess the intention by considering why does the customer need that particular good or service. If they need it for the continued existence or the continued operations of their own company, then you can argue that they've got an intention to pay. In other words, it's like probably a trainee accountant, and we are saying that the trainee accountant decided to buy a car during their training contract. And we are considering whether they've got an intention to pay. We can argue that the trainee accountant has the intention to pay because they need the car to actually be mobile and move to clients back and forth and so on and so on. So by that particular argument, we can decide and conclude that there is an intention to pay. So here, probably just consider how the customer is going to use the good or the asset that they've received. How customer intends to use the goods. So those are the kind of things, or those are the 5 things that you need to assess before you continue and apply step 2, 3, 4, and 5. So if when you are assessing this, you find that one of the conditions is not met, they are saying that you cannot go and start talking about the rest of the conditions, because for the contract to be accounted for in terms of IFRS 15, it has to meet all those 5 conditions altogether. Probably you are assessing this contract, and at a particular time, the customer is actually struggling, it's suffering losses. So that means all these other conditions, you can argue that they are met. And what they are saying is that if you assess these conditions and you find that they are not met, you need to continue to assess them until you get to that point where they are met, and therefore proceed to the rest of the steps. But if they are not, any consideration received under this particular contract cannot be recognized as revenue altogether. So for instance, maybe the customer says that, I know that things are not looking so good right now. Can I make a deposit? So if the customer decides to make a deposit, what they are saying is that traditionally when you enter into a contract and someone promises to pay later, you have to recognize the entire revenue and the contra account will be accounts receivable. But they're saying that if these conditions are not met, you cannot do that. You have to recognize bank, and any payment that he has made, you recognize it as a deposit liability. Is that clear? But if these conditions are met, what they are saying is that you will then say debit bank, debit accounts receivable, credit revenue. Do you see the distinction between this? And here, let's say the goods is worth 100 and he has made a deposit of 10. So if the conditions are not met, then you will recognize just the 10 that he has made. But if the conditions are met, you will recognize the entire revenue of 100 and accounts receivable of 90 and the bank of 10. Do you see how that can impact the financial statements? So that's what they're arguing here, that if the conditions are not met, the consideration received under the contract cannot be revenue. Is that clear? And you have to recognize the amount received as a liability, representing your obligation to refund the customer or the obligation to deliver the goods for which he has paid the deposit for. So that's what they're arguing. So you just need to be careful when you assess the contract for the requirements of paragraph 9. Then they're saying that after initial stage, you continue to assess this. So in terms of when, it depends on the circumstances. Probably this contract might have occurred during the year, and you might have been doubting, maybe you are saying that you are waiting for how the interest rate will move, or you're waiting for the next Stats SA announcement on the economic status, and so on and so on. So maybe after that particular period, you can then assess the contract again to check whether you've got a different outcome. But they're saying that until you get to meet all those conditions, you have to continue to assess. Otherwise, you might need to consider the other two conditions, where they are saying that if you don't have any further obligation to the customer. So in other words, you are saying that this was a liability, but for one reason or the other, maybe there was a time period and this time period has expired. And the agreement was saying that if you don't fulfill or you don't pay the rest of the 90 within the next 3 months, then I get to keep the deposit. So if that is the case, they are saying that if you get to that particular point where you don't have any further commitment to the customer, then the liability will need to be reversed. So if it is reversed, you can argue that we need to recognize the 10 that has been received as either revenue or simply just other income. But we are saying that we no longer have any obligation to fulfill to the customer. We have met our terms, we waited for the customer for 3 months and he didn't come through. So the 10 that he has paid us, he had already agreed that that is gone. So we are allowed to reverse the liability and recognize income or revenue in relation to that amount received. Is that clear? Then they are saying that if the contract is terminated, maybe the customer decides that this is no longer working out or is not going to need the goods anymore, then if that contract is terminated, if we've got the right to retain that particular deposit, then that deposit or the liability has to be reversed. And we're going to recognize revenue or other income relating to it. Is that clear? Otherwise, we have to keep on assessing the contract. Then it talks about combination of contract. It says that if you enter into a contract with the same customer and the commercial substance of that contract is actually what? It's meant to be considered, or it's got a single commercial objective. Then they're saying that instead of applying these requirements for the different contracts that are there, you might need to combine the contracts and assess them together. But because probably when you're talking about the customer, you probably need to assess his credit his credit status just once. So those kind of things, they're saying that that's a situation where you might need to combine contract if they are entered into with the same customer and around the same time, and they've got a single commercial objective that they intend to achieve. So that is step number 1. So you'll notice that in your standard, they also go into contract modification. So SAICA has decided to say that contract modifications are level 1, meaning that it's something that you don't need to be too concerned about. So make a note of it, because at the back of the standard, there's quite a number of examples relating to contract modification. Some of the examples are a bit complicated, but what they're saying is that do not worry about that. We'll not ask you something as complicated as that. That then concludes our discussion on step number 1, which is identifying the contract. So it seems that on step number 1, it is a matter of deciding whether the contract should be accounted for in terms of IFRS 15 or not. And for you to do that, you have to consider all the 5 requirements individually and make sure they are all met at the end of the day. Is that clear? Now, step number 2. Step number 2 is by far the most important step in this revenue framework. So step number 2, you need to really be careful with it. It sounds a bit light, and even in terms of the content, when you open the actual standard, it looks a bit light. But the key thing about it, as I said before when we started, is that your answer to step number 2 can impact step number 4. And the risk there is that if you say that you've got, say, maybe one performance obligation, it means you are not going to talk about step number 4. And step number 4 sometimes is a big step, which means that if you miss to address step number 2 properly, that can end up costing you major marks in the question. So now let's just understand what step number 2 is all about. So step number 2 says we need to identify the performance obligations in the contract. So now the question is, what is a performance obligation? A performance obligation is simply what? It's simply a promise to the customer to transfer goods or service. So it is a promise to the customer to transfer what? Promise to transfer goods or service. So that is number 1. So what they are saying is that if I come to you and say that if you give me 100 rands, I'll give you this. My performance obligation is to deliver this altogether. But then they went on further to clarify that the goods that we are talking about are actually goods that are distinct. So these goods or service, they have to be distinct. So they cannot just be, they're just not talking about normal goods and service. They say that for it to be a performance obligation, the goods or service that are to be delivered to the customer or promised to be delivered to the customer, they have to be distinct. So now, let us just understand what it means when we say goods are distinct. We have to then refer to what? To paragraph 27 to 29. So let's proceed to slide 59. So in this particular instance, the standard defines what we mean or what it means when you say that the goods are distinct. Goods are distinct if they meet 2 conditions. And these 2 conditions are considered from the perspective of 1, the customer, and also from the perspective of the supplier. So from the perspective of the customer, we are just asking the customer, you as the customer, are you able to benefit from this good or service on its own? So if it is distinct, the customer has to benefit from what? From the good on its own. So this is benefit in terms of probably using or selling or holding altogether. So when you say benefit, it could be a benefit because they intend to use that particular good that has been acquired, or they intend to resell it. So it could be inventory to the customer, or it could be an item where they hold and it appreciates value over time. But we are saying that there is a benefit, and that benefit can be obtained from the good on its own, or with goods that are readily available in the market, that are readily available in the market. So that's what we are saying then, that the customer, for the goods to be distinct, they need to be able to benefit from that good on its own or with goods that are readily available in the market altogether. If we make a simple example, you go and buy a DSTV decoder along with a satellite dish. You've obtained what? A good, say, from a game or any other store. And now the question is, have you acquired a good that you are able to benefit from its use on its own? Yes or no? Are you able to benefit from having bought the DSTV decoder along with a satellite dish? Are you able to benefit from that good on its own? Yes or no? So right now, if you go and pick up that decoder and the dish, you're able to enjoy it from now. Huh? And what else will you need? So you'll need probably for it to be installed, what else? You're gonna need a TV. So you cannot enjoy a DSTV decoder and a satellite dish on their own, altogether. But they don't stop there. They say that if the good cannot be enjoyed on its own, it has to be enjoyed with goods that are readily available. So whatever that you need, is it something that is readily available in the market? Is it difficult to get a TV? Will you be at loss to say that you got a DSTV decoder installed but you don't know where to get a TV? No, because a TV is readily available in the market. So that means when Game has sold you that DSTV decoder and the dish, they can recognize revenue because they are able to say that the customer is able to benefit from that good with goods that are readily available in the market. So even if they don't want to buy a TV from us, that's fine. They can go somewhere else and buy a TV because it's readily available. There's no restriction. There's no that if you don't buy it now, you're not going to get it later and so on and so on. So that's what they mean when they're saying that what? Benefit from the good on its own or with goods that are readily available in the market. That's condition number one, altogether. Then condition number two, it relates to what? To the supplier. It says the promise to deliver that good or service, is it separately identifiable from other promises in the contract? So is it separately identifiable from other promises in the contract? So when you discuss this, we want to see the link between customer and benefit. We want to see the link between supplier and separately identifiable. Because sometimes when we mark this, we see that students don't recognize that customer talks to the benefit and the supplier talks to what? Separately identifiability of the performance obligation. So we are saying that the contract could require the company to do so many things. But the question is, are those promises separately identifiable from each other? That's what we want to know. So let's understand, or let's see what the standard says needs to be considered. So the standard says for the goods to be separately identifiable from each other, we need to consider three questions. It's an OR test again. So here we are saying is that is the good that we are looking at, the good or service, is it an input to a combined output? Is it an input to a combined output? The good that you're talking about, is it an input to a combined output? So the classic case here is when you are probably going to buy a car. Let's say that you decide that you want a Mercedes-Benz. Then you go there to the dealer, and the dealer gives you a little checklist. And they say, what do you want? And you tell them that you want a Mercedes-Benz. Then they probably say that then use this checklist to tell us what you desire in a car. Then you will start off by saying C-class, E-class, and so on and so on. Then you will probably need to tick that you want probably a C-class. Then under C-class, maybe you tick that you want what? A C200. And they'll say standard price of a C200 is 500,000, for instance, right? So now you have ticked that you want a C200. Then you see below here that there are what? Optionals or extras. And under these extras, they've got what? They've got sunroof. And they say next to it, let's say 15,000. So now you are looking at this thing and you are saying that the entity, the dealer or the manufacturer, right? When or if you decide to come and tick the sunroof, are you demanding a good that is distinct? In other words, the company's obligation to give you a sunroof or to transfer the sunroof to you, is it something that is separately identifiable from their other obligation? So in other words, when we look at your checklist, you have ticked that you want a C-Class, which is a standard. It comes, it's a car that is ready to be what you intend it to be in terms of it can move, 0 mileage, and then it's got this particular specification, doors, and all this other thing. The only thing that we are saying it doesn't have is the sunroof. And you are saying that, yes, you told the supplier that you want the C200 standard, but from the extras, you have ticked that you want a sunroof. And what the standard is asking the supplier or the manufacturer is that the customer that you are dealing with, does he want 2 distinct goods from you, or does he want just one thing from you? That's what we are asking. Do we have a distinct good that is a standard car and a distinct good that is a sunroof? That is the question that is being posed to the dealer or to the manufacturer altogether. Then we are asking, or they're saying that for us to come up with that answer, we need to ask these 2 questions. That number 1, is the customer able to benefit from the use of the standard car on its own altogether? And is the customer able to benefit from the use of a sunroof on its own altogether? That's what we are asking. That's what this first question is asking. That the goods under the contract, is the customer able to benefit from their use on their own or with goods that are readily available in the market altogether?
I just want to ask, so if we're doing a discussion question,
Yes.
I should also discuss the customer and the supplier.
Yes. That's what we are saying. So we are saying that you're going to start with the customer and you talk about the goods that are in the contract. And you are actually saying that, so probably you put this as a brief what? As a brief introduction, that we need to consider whether the customer benefits from the goods on their own or with goods that are readily available in the market, right? Then when you apply, you'll say that the customer is able to benefit from the use of the car without a sunroof. That will be an application altogether. So that's how you need to think about it, and that's how you need to approach it. Then you will need to say that from a supply perspective, we need to consider whether the delivery or the promise to transfer a car and a sunroof are separately identifiable. Then you start with these other requirements. Are we together? So now what we are asking is whether the sunroof, is it an input to a combined output, or is the sunroof a separately identifiable good under the contract? What do you think? What do you think? So in other words, the supplier cannot ask you to come pick up the car and pick up the sunroof later on altogether, because the sunroof is actually an input to the standard car that you want. So for you to sign off and say that you have fulfilled what I want from you is when he delivers a car with a sunroof altogether. So essentially the question, you can modify it to say what is the obligation to deliver a car with a sunroof, or is it to deliver a car and a sunroof altogether? Because if you say it is a car and a sunroof, there are 2 performance obligations. But if you say that it is a car with a sunroof, it's 1 performance obligation altogether. And as I'm saying, that answer impacts on what you do in step number 4. So are we clear? Do we have a car with a sunroof, or do we have a promise to deliver a car and a sunroof? Do you have a question? Yes.
Is it always like that, or it depends? Because if maybe a supplier can sell a sunroof to any customer who comes to, let's say, I want a sunroof, then I'm installed
No, but the question here, remember that we've got a contract. This is a single contract. So the revenue standard is applied on a contract basis. So if someone comes later and says they want a sunroof, that's contract on a standalone. So we're going to assess it on that. But here we've got one contract with two promises. You have promised the customer a car and a sunroof. But the question is that, have you promised the customer two things, or have you promised him one thing that is just in that particular niche? That's what we are talking about. So the fact that it can be normally sold, it can help us probably to determine whether this is an input. But at the end of the day, we are confined to this particular contract. So the fact that it can be sold on its own is not generally the overriding factor here. So it's under the contract. Are we promising under this particular contract two things or one thing? That's what we are trying to do. Is that clear? Then, number two, they say that, so in other words, if you say no, right? Because we are saying, is it an input? Sorry, is it an input to a combined output? If we say yes, the sunroof is an input to a car, then we are saying that there is what? One performance obligation altogether. That we are required to only deliver a car. We cannot recognize the revenue under the full revenue under the contract if the car we deliver does not have a sunroof. So it means that the revenue that we've contracted to, we won't be able to recognize it in full until the entire performance obligation has been fulfilled. Is that clear? So since it's an OR test, so if now the answer is what? If the answer is no, so if the answer is no, we move on to assess the next one. So is the good or a service an input to a combined output? No. Then we check the next one. Is that clear? So if the answer we've gotten was a no, then we check the next one. But if it's yes, we can stop here altogether. Then the good or service, does it, the good or service, does it significantly modify, does it significantly modify or customize another good in the contract? So remember, it's a single contract, another good in the contract. So we've got one contract, and we are asking, does the good that is now requested as an additional, does it significantly modify another good in the contract? That's what we are asking altogether. And again, we are assessing one contract with so many promises. And what we want to determine is whether the promises are standalone, distinct goods or not. So maybe, in addition, there was an option that says AMG sports kit. And it said 30,000 next to it. And you also ticked it. Now we are asking that the AMG sports kit to be delivered, or that you desire or you want from the supplier, is it a distinct good or a distinct service that the supplier has to provide to the customer? That's what we are asking. Is that clear? So now, in this case, we will need to ask, does the AMG sports kit significantly modify an existing good in the contract? Is that clear? Because the way that this sports kit works is that you've got your normal car with a standard engine. And then if you put in the sports kit, they change the design and the look of the vehicle, as well as modify some of the performance of the vehicle. So now you have ticked that you want that as well. Now the question is, did you demand an additional good to the car that you've already demanded from what? From the company. Is that clear? So now, what do you think? Is the AMG Sports Kit an additional distinct good, or is it that the customer is buying a C200 with a sunroof and that has been modified with the AMG Sports Kit? What is the customer demanding? Is it an additional good or service that he desires from the supplier, or he's just demanding a car with a specific characteristics or qualities? That's what we want to know. Because if you then say that there are two distinct goods, that means some of the consideration that the customer has to pay, they have to be allocated to what? To this particular item. And we have to assess the satisfaction of that performance obligation separately. Otherwise, we are considering it to be one item, and we are saying that the entity can only recognize revenue once it has delivered a car with a sunroof and with the AMG Sports Kit. That's what we want to know. So what do you think? Do we have a distinct good or service with this AMG Sports Kit? Yes or no? Remember that the way that you come back, you are trying to respond to the question that it's separately identifiable, right? So you cannot have a yes or no without at least referring to this. So your yes or no needs to be followed by, yes, it is an input to a combined output. No, it is so on and so on, altogether. It cannot be an answer outside those three things. Do you see how you think about it? So it cannot be an answer outside. So if you say that it is possible for someone to come and get an AMG Sports Kit at a later point, that is not part of these requirements. These requirements are saying, is it an input or a combined output? Does it significantly modify another good in the contract? So you need to say, yes, it is an input. No, it is not an input. No, it does not significantly modify. Do you see how you answer this? Are we clear in terms of how you answer separately identifiability? So now, what do you think? Does the AMG Sports Kit, is it a separately identifiable performance obligation, or there is only one performance obligation here, which is a car? What do you think? We've got two. Okay? What do you think? What is your reason?
Because it significantly modifies the standard missing, I would say, because it's separately.
Yes, maybe what I need to confirm is that it's a negative test. So if it does, then it is not. So in other words, if it's significant, if the answer is yes, then it is not separately identifiable. So yeah, that's that test, right? Because the way it says, they say that we have, because you can see the not in those statements, can you see? To highlight that it's actually a negative test. So it is separately identifiable if it is not an input. It is separately identifiable if it is not, if it does not significantly modify. So if you say that it significantly modifies, you are saying that it is not separately identifiable, and therefore there is only one altogether. So it's a negative yes, right? Yeah, how do you call it? Yes, it's a negative test. So negative is positive to the question of, is it separately identifiable? Right? So if it significantly modifies, then it is not separately identifiable. Therefore, you have one performance obligation. Yes, so if it does not significantly modify, it is actually separately identifiable. Then you've got two performance obligation. Is that clear? But as I'm saying, remember that when you answer here, you have to touch on those requirements there. It cannot just be a yes or no is separately identifiable. You have to address them. Are we clear? Then the last one, it says, is the good or service, is it highly dependent or highly interrelated, highly dependent or interrelated with another good promised in the contract. So here, a classic case is software that you buy in a disk, for instance. And the most classic of them all is the PlayStation games. So if you've got a PlayStation 3, 4, and so on, if you want to get the benefit from that device, you need to buy the PlayStation games. And the way that the PlayStation games, or what you are paying for, when you look at the CD looks like any normal CD. But when you check the price over there is actually determined by what is in that particular disk. So what you are buying is not the disk, but it's actually the software in the disk. So the quality of the game, of the software in the disk, determines the eventual price. So the disk will be all there, and you'll find that there's one game for 200, one game for 900, and so on and so on. Because what you are actually buying is inside what? It's inside that particular disk. And furthermore, yes, you are buying the content in a disk, but the way that they've tried to protect the market is that if you attempt to remove the content from that particular disk, the content will not work unless it's actually in that particular disk. So the disks are specially designed, and they've put in a code that talks to the PlayStation device so that you are able to access the content. So it's not that I can buy the game, copy, and give it to you, and so on and so on. If you don't have the specific disk, you are not able to access the software inside that particular disk. And now the question is, probably there was effort in terms of developing that particular disk. And what we want to know in this case is whether when you buy that particular game, are you buying the software as well as the disk? In other words, the two are two separate performance obligations, or they are two distinct goods. In which case, the supplier has got what? Two performance obligation. And now we are saying that if the goods are highly dependent or interrelated to each other, then those goods should not be separately identified, but it should actually be considered to be one thing altogether. And because what we are saying is that the game, since it requires the disk, it is highly dependent on that particular disk. And if it is highly dependent on that particular disk, what we are therefore saying is what? We are saying that the two are not separately identifiable. And therefore, when you buy a disk, you are actually buying a single item. Is that clear? So what we are looking at here is whether the goods are highly dependent or interrelated. Can the good be used without the other good? And if it's impossible, then the two are not separately identifiable, but they're actually the same thing. Is that clear? Does that make sense? So that's how you need to think about what? That's how you need to think about step 2. So in an exam, you get there, and you're saying that step 1, you've gone through that one, those 5 things, and have concluded on step 1. Then you're saying, number 2, we need to identify the performance obligations under the contract. Then probably you summarize and say, that means we need to transfer the goods or services being promised to the customer, and those goods have to be distinct. Then for those goods to be distinct, we need to look at it from the perspective of the customer and the supplier. In this particular case, the customer is able to either benefit from the goods on its own, or with benefit from the good with other goods that are readily available in the market. And in this particular case, you are dealing with an end test. For this one, it's an end test. So the customer has to be able to benefit from the use of the goods on its own, and the suppliers, from the supplier side, the promises have to be separately identifiable. If you say that the customer is unable to benefit from the good on its own, you don't need to talk about this. This good is not distinct, or the goods in the contract are not distinct. Are we together? And if there are two things in the contract, you test for one, and then that means the other one is automatically met. So, for instance, if we are talking about what? If you buy a TV and a DSTV decoder, right? And we are asking whether you've bought two things or one thing. Then you can say it is possible to use what? To use the TV on its own altogether. By saying that it's possible to use the TV on its own, since you've got two things, it means that the DSTV decoder can be used on its own as well altogether. Because the two, by that definition, we are saying that they are not related, since there are two items. So in this particular case, the way that you need to say it, you can say that it is possible for the customer to benefit from the use of a TV apart from the DSTV decoder altogether. So by saying that, you are saying that it is separately identifiable. Because if it's not, you need to then communicate that the two can only be used together. Does that make sense? Then, from the supplier's perspective, remember you want to get to whether it's a yes, separately identifiable, or no, not separately identifiable. Then you have to test and make sure that those three conditions are addressed or considered altogether. So that is how you test for whether you've got one performance obligation or you've got two performance obligations. And do not forget about the last mark. The last mark is to say, therefore, the good one is the goods, let's say the goods. The goods are distinct items. There are two performance obligations, or three or four, depending on your answer. But that's how you conclude. Sometimes some examiners give these 2 marks. So you have concluded that the items are distinct. And you know that if they are distinct, then you've got more than one performance obligation. So they can consider those as being 2 separate marks. So don't forget to conclude whether the goods are distinct or not. So if you have assessed and you found that the goods are not distinct, then you need to say that the 2 goods are not distinct, right? Therefore, we need to consider them as a single performance obligation. But again, some consider those to be 2 points that you are able to see the link of your first conclusion of whether the goods are distinct or not in relation to the conclusion of how many performance obligations you've got. Is that clear? So that is what step number 2 is all about. And just to consider some of the things that they also talk about in the standard. They say that sometimes when you talk about performance obligation, without really complicating it, performance obligations are often stated in the contract. Like your employment contract, it will say what? It will say that you need to perform activity 1, 2, 3. So those are your performance obligations. And they will say that you are entitled to a salary of so much at the end of the month. That is the supplier's performance obligation, and you're right after you have fulfilled the performance obligation stated in the contract. And they are saying that sometimes there can be contracts which include activities that must be fulfilled, but those activities do not transfer a good or a service to a customer. And they make a classic example of an estate agency. An estate agency, if I want to sell my property, I call them up and say that I want to sell my house, I want to sell my building, and so on. Then I ask them, or they tell me that they charge a commission of 2%. They're asking how much I want. If I say I want 1 million, then they're saying that they will keep 2% of that R1,000,000 altogether. So in that particular instance, what we are saying, or what the standard is saying, is that after you've given the money to the estate agent, he starts marketing the property. He will need to put the property probably on Property 24 or some of the channels that he believes that will be able to get leads. And when people call, you'll need to take them to the property, show them around, market or advertise the property properly. And at that particular point, you have no obligation to that particular estate agent. So if he does not sell the house, most of the time he cannot come and claim the money that he spent on advertising or any of those activities. So the standard then says that because his obligation was to sell the property, therefore any activities that he does before selling of the property, they cannot be considered in terms of recognizing revenue. The only time he will recognize revenue is when what? Is when he actually sells the property. So any activities performed prior to selling the property will not be taken into consideration in determining the revenue to be recognized. Is that clear? So that is how, or that is what they mean with the last statement on slide 58. So that is step number 2. Any question on step number 2? Any question on step number 2? Are we clear what is required in step number 2? Then, the way that the standard is organized, you will see that it suddenly jumps to step number 5. Why does the standard jump to step number 5? Why does it not continue to step 3 and then 4 through to 5? Why does it skip step 3 and 4 and only talks about them later? So step 1, step 2, and step 5. What they talk about is the recognition of revenue. So step 1, 2, and 5, they talk about recognition. So when you get a question, read the question carefully. If the question says, discuss the appropriate recognition of this particular contract, you will be in the right mind to only talk about step 1, 2, and 5. They talk to the recognition of revenue. At this particular point, you are not talking about any number. You are just saying that, is it appropriate to recognize revenue or not? Is that clear? That's why the standard starts there. Because they're saying that, let's not talk about measurement, because what if the contract, or what if you have not met the, what do you call it? What if you have not satisfied the performance obligation? Whether the contract is 10 million or not, as long as you have not fulfilled the performance obligation, 0 revenue has to be recognized. So they're saying that let's start with what? With the recognition principle. So if the question talks of measurement, then you are talking, or you are looking at what? You are looking at step 3 and 4 only. It's just sometimes, as I said before, to talk about step 4, you cannot skip what? Step 2. And that's what they did in one of the previous ITC. They asked you to talk about what? To talk about the recognition of revenue arising from the satisfaction of performance obligation. But they knew that you cannot talk about this step unless you know how many obligations you've got altogether. So even though the question was not implicitly talking about step 2, the question or majority of the marks were sitting here. Because essentially, what will you talk about if you have not identified whether there's 1 or 2 performance obligations to fulfill? Is that clear? Then, let's talk about step 5 then. They are saying that revenue should only be recognized when you have fulfilled the performance obligations. So we have identified in step 2 what are the performance obligations in this particular contract. And they're saying that only when you fulfill them, that is when you do what? That is when you recognize revenue. So when do you consider yourself having fulfilled a performance obligation? They say that a performance obligation, like in most cases, it is fulfilled when control over the goods or service is actually transferred from the supplier to the customer. So a performance obligation is fulfilled when control is transferred. So it is fulfilled when control is transferred. Out together. So, and also just to clarify, the standard then says when you talk about goods or service, rather than keep on referring to goods and service, we're going to just call them an asset. So they say that the performance obligation is fulfilled when an asset is transferred. So there when it talks about an asset, it says that asset actually refers to what? To the good or service in question. So if you have transferred control of the asset, then the performance obligation is what? Is satisfied. But before you get there, you need to ask, or as part of this process, you need to ask whether the performance obligation is satisfied at a point in time or over time. So is the performance obligation satisfied over time or at a point in time? And here, time is not used broadly or loosely as we know it. So it's not time as this thing will take me 3 months. So it could be that I've got a contract that will take 6 months to complete. But I will only be allowed to recognize revenue at the end of the 6-month period. In other words, it will be at a point in time which is after the end of the 6-month period. So don't think that the activities and the fulfillment of activities over time actually talks to the performance obligation being satisfied over time. So time here is not time as we know it. It's actually weird time. I don't know, but you understand what we are saying, that time should not be an indication of whether obligation is satisfied now or over time. So it's a matter of the principles in the standard that I can have a contract that started in June this year and is due to complete at the end of December. So when you think about such a contract, the mind will probably say that that means revenue is recognized over time. But that's not how the standard is thinking about it. It says there are specific requirements on whether you will recognize the revenue over the 6-month period or whether you will recognize the revenue at the end of the December period altogether. So what do you need to consider to determine whether revenue is over time or at a point in time? It says consider the 3 requirements in paragraph 35. In paragraph 35, they are saying what? They are saying that an entity transfers control over time and therefore the performance obligation revenue is recognized over time if one of the following criteria is met, just one. So out of these 3, in an exam, you might be required to talk about all of them altogether so that you get to the correct one which is met. So what is the first one? So the first one, it asks, does the customer simultaneously receive and consume the benefits of what? the benefits of the entity's performance? Are we simultaneously receiving and consuming the benefits? So what is the classic example over there? The classic example over there is security services. That when the security are out there protecting the building or guarding the building, what are they doing? They are fulfilling their performance obligation. And what are we doing as the customer? We are receiving and also benefiting from their performance altogether. You've paid for your DSTV subscription. Then after ITC, when you actually sit down to watch television, what do? You are receiving and consuming the benefits of your subscription altogether. That is how condition number 1 works. Is the customer simultaneously receiving and consuming the benefits of the entity's performance? Are we clear? Then number 2, does the entity's performance, so entity, remember, that's the supplier. Does the entity's performance create or enhance an asset that is what? That is controlled by the customer? Does the entity's performance create or enhance an asset that is controlled by the customer? What does that mean? Your car was recently involved in an accident and you took it to a panel beater. The panel beater says that you can fix your car. So let's say it was badly damaged. So he can enhance the asset and make it better or restore it to its original condition. So in that particular instance, we are saying that the performance of the panel beater altogether, it is enhancing an asset that already belongs to you altogether. So that means what we'll be saying is that that will be a performance obligation satisfied over time as he modifies your asset. You took your car to what? You took your car to the car wash. So that is an activity that will enhance an asset that you control. You are entered into a lease agreement that requires you to do some improvement. And when you actually build on the lessor's property, you are enhancing his property. And by law, any enhancement that you make on his property belongs to him. So in that particular instance, the asset that you are creating actually belongs to who? It belongs to the lessor. So as a result, what do you have? You have a performance obligation satisfied over time. Then, if none of this is true, you go to the last one. The last one has 2 conditions in it. It says, does the entity's performance, so actually it says that the entity's performance does not create, so again, another negative. It does not create an asset with an alternative use. And in addition, the entity has an enforceable right to payment. So 2 conditions. 1, the entity's performance does not create an asset with an alternative use. And in addition, the entity has an enforceable right to payment. And the classic example is an audit. So let's say that you got an engagement to do a forensics audit for a particular company, right? And you agree that this will be a 2-month assignment or let's say a 6-month assignment. And you agree that you're going to charge the client, say, R1 million for that assignment. And now the question is, what are you required to deliver, you as the forensic team? You are required to deliver a forensics report altogether. So now the question is, your performance, when you are performing and you're investigating and documenting your findings, are you creating a report that might have an alternative use? In other words, if the customer or if the entity says no more forensics or no more investigation, your contract is terminated after 2 months, are you able to take the work that you've done and use it for another audit that you might have in the future? No. The reports that you are working on, the findings, are actually what? Are actually specific to that entity, and they don't have any alternative use altogether. So that means the first condition has been met, that you are creating an asset that has no alternative use. Then the second condition, it says, are you able to enforce or to demand the right to payment? So it says that does the entity have an enforceable right to payment? And when you read this, the standard is quiet about what enforceable right means. You have to go to the B section for you to understand what it means altogether. So the B section clarifies the following. It says that if under that contract you are able to recover your cost from the client and then the contract is immediately terminated, then you do not have an enforceable right to payment. In other words, the enforceable right to payment does not talk to the recovery of cost altogether. If you are able to just recover your cost under a contract, what they are saying is you do not have an enforceable right to payment. So what does the standard say is an enforceable right to payment? They say that an enforceable right to payment is the payment that you will get in the market. So it's like a market price for the uncompleted asset altogether. So you were busy in a contract. The contract is terminated. You are halfway done with the project altogether. But the problem is that the asset that you're creating has no alternative use. So you might then say that, guys, I had spent 100 hours here. And spending 100 hours means that I've been out of pocket 300,000. So if the client agrees to reimburse your out-of-pocket cost, then the standard is saying you do not have an enforceable right to payment. What you have to be able to do is to demand the cost that you have incurred plus a reasonable profit on top of those costs altogether. Or you need to say that this is a half-completed report. If someone was to pay me for this report, what will be the market price for it? So it is not the recovery of cost, it is either the market price of the uncompleted goods or the recovery of your cost plus a reasonable margin. Is that clear? So that's why I was saying that when you read this standard, you have to also refer to the B section. Because if you just keep it here, you might think that this is just a situation where someone says, I've spent so much and I want you to reimburse me. But the standard says that's not enough. You have to charge either the market-related price of the uncompleted goods or the cost recovered plus a reasonable profit altogether. So that means for number 3, does not create an asset with an alternative use. Tick. Does it create an enforceable right to payment? Are we able to demand the market-related price for the uncompleted asset or are we able to recover our cost plus a reasonable profit? Is that clear? So let's do this example, then we'll take a short break. So we've got CA Limited, which manufactures fire engine on an order basis, based on customer specifications. CA Limited received an order from Oak Bay to construct what? A fire engine. The contract price is 3 million and the cost to complete are estimated to be what? 2.4 million, right? Oak Bay has a mine in Kimberley, and this is the only mine in Kimberley. The terrain and weather conditions in Kimberley are unique relative to other parts of the country. And as a result, the fire engine manufactured in accordance with Oak Bay specification cannot be sold to any other client without major modifications, right? If Oak Bay cancels the contract before construction is completed, Oak Bay will be required to pay CA Limited, the supplier of the entity, all the costs incurred to date, plus a margin of 20%. On 1 December 2015, the total construction cost incurred amounted to what? To 1.920. Advise CA Limited whether its performance obligation will be satisfied over time or at a point in time. If the profit margin of 20% is considered a reasonable profit margin in terms of IFRS 15, paragraph B9. The margin of 20% is not considered a reasonable profit in terms of IFRS 15, paragraph B9. So B9 is the one that talks about the right to enforceable payment. So now, looking at this, so let's just jump to what? Let's just jump to, because if you go through this, you'll identify that there's a contract, and step 2, you'll be able to identify that there is only one performance obligation altogether. And that performance obligation is the delivery of the fire engine. So now let's just paint a picture of the impact of this over time and point in time. So the revenue recognition process, if it's over time, what we are saying is you need to use what we used to call in the old standard stage of completion altogether. So the stage of completion, let's say you've got a contract with revenue of 3 million, right? And cost of 2 million. And cost incurred, and maybe at the end of the year, at year end, you are 60% done altogether. If you say revenue is over time, at the end of the year, you need to recognize 60% of the total contract price altogether, which means which actually means that someone will be recognizing 1.8. But if you say that it is actually at a point in time, and at the end you are 60% done, you need to recognize 0 revenue. So can you see that the financial reporting of the two companies can be vastly different in terms of what they conclude on how to recognize revenue? So over time allows you to recognize a portion of revenue as and when you fulfill a performance obligation. At a point in time says only when you're 100% done with the contract can you recognize revenue. Only when you've delivered the item. Is that clear? So this is why they had to clarify how you actually get into overtime. Because if you don't, this for some companies like construction and other companies that take long-term projects, this can have a dramatic impact on the revenue they report. So it is quite important that when you talk about overtime or at a point in time, you actually consider those requirements. So let's look at this. So what do you think about this? do you think this is a contract whose performance obligation is satisfied at a point in time or over time? Why? Is it point in time or over time? And why? What do you think? So he is saying that the entity does not create an asset with an alternative use. How do you know? Remember that you have to apply, right? How do you know that there is no alternative use to this asset? But is it enough if the asset is just designed for me? Is it enough to say there's no alternative use? So the fact that the asset is manufactured according to customer specification is not enough to say it does not have an alternative use. You have to provide additional information to say that there is no way the entity can sell it to any other customer without major modification altogether. So that means in an exam, to actually apply that point, you will then need to say to the examiner that there is evidence to suggest that the asset does not have an alternative use. Because one, it was specifically manufactured for Oak Bay. Oak Bay is based in Kimberley, and the terrain in Kimberley is what is quite unique relative to other parts of the country, meaning that it might be difficult to use this asset in any other part of the country or for any other client. Even more, there's only one mine in Kimberley. Then, if the entity decides to sell the asset to any other client, it cannot do so without major modification. So those would be the points that support that there is no what? That there is no alternative use of the asset. Because it could be, and especially with what? Especially with cars. Like if you go to Mercedes now, you can actually sit and design the car that you want. And surprisingly, I think they only want 5,000 to even design and manufacture a 500,000 car for you. So they will take your 5,000 and design the car that you want. But they know that even if you design to your own specification, there's going to be an alternative use for that asset. Because someone might actually take it, or they can actually sell it to someone. Is that clear? So whether the asset has been designed according to a customer specification does not make or does not conclude or result in the asset not having an alternative use. The key thing is that there need to be a situation where the asset cannot be sold to any other client without major modification. Is that clear? So that part, tick. Now, question number 2. Does CA Limited have an enforceable right to payment now that the contract is terminated? Oh, sorry, if the contract is terminated. If the contract is terminated, does CA Limited have the enforceable right to payment? Yes or no? How do you know? The last paragraph says it can claim or it can demand all the cost incurred plus a margin of 20%. Does that mean it's got an enforceable right to payment? So, what B9 of IFRS 15 says? It says that we have to consider whether that margin is reasonable or not altogether. So it's not a matter of margin. It even goes as far as saying that you need to consider the margin in relation to the work altogether. So that means the key thing that you need to consider, like part A said, assume that that's a reasonable profit margin. And part B says that is not a reasonable profit margin. So if it is a reasonable profit margin, then the entity has an enforceable right to payment altogether. So it is not just a matter of recovery. There is an additional question of whether what they're going to recover is reasonable altogether. So if it is a reasonable profit margin, then you can argue that condition number 2 has been met. And therefore, this is an obligation satisfied over time altogether. But for part B, we are saying that the profit margin of 20% is not a reasonable profit margin in terms of B9. And as a result, we are arguing that condition number 2 is not met. And if condition number 2 is not met, it means that you have to go and test this one. Do you understand? So if 1 is met, you are fine. But if this is not met, you have to test the remaining 2. So we are saying that for part B, or for Roman figure 2, there is no enforceable right to payment. So condition 3 fails. So now we ask, is the entity creating an asset that is controlled by Oak Bay? There is no evidence that Oak Bay controls this because the asset has not been delivered to them. Ownership and control has not been effected. Does the customer simultaneously receive or consume the benefits? They need the vehicle to be at their premises to receive the benefit. So that means all the 3 conditions have failed to be met. And if they fail to be met, we have an obligation satisfied at a point in time. So let's talk exam technique. So from an exam technique, if it is over time, you can get away with just discussing 1 altogether. But if it is a point in time, then there's likely to be about 3 marks reserved when you talk about the different requirements. So you cannot get to point in time without talking about all 3. But you can get to over time by just talking about just 1. So that is from an exam technique perspective. Does that make sense? So like the way we've done it, we said it's over time because we just looked at condition number 3 only. But for us to say it's at point in time, we had to look at condition 3, condition 2, as well as condition number 1. Does that make sense? Are we all clear? So let's take a short break.